Hello, folks. This is Steve Memory from Iconic Wealth Management with our February 2020 Leap Year Edition comments. You know, looking back, February 19th was just about the perfect day. We just came off Valentine's Day. We had a long weekend due to the President's Day holiday. The markets had recovered from a difficult January, and the S&P closed at a record high. The Dow was sitting at 2934. All seemed right in the United States, if not the world. I mean, there was that flu thing in Wuhan, China, but that was halfway around the globe. By the end of the month, the biggest weekly losses since 2008 gave us the fastest correction in U.S. stocks ever. In just 10 days, the Dow closed down almost 4,000 points from its high. That's roughly 13.4%. In fact, all three major indexes are down about 13%, with more than 95% of the S&P 500 stocks down in excess of 10% from their highs. And a new word entered our vocabulary: coronavirus. So, today, we're going to take a look into the coronavirus. What is it? How it spreads? Its impact on the economy and you as an investor. As always, be sure to stay tuned at the end of this video for a required disclosure statement. You know, the stock market is used to digesting a lot of information. But the coronavirus is different. It's a variable from outside the financial world, whose impact on the global economy is potentially huge, but ultimately unknown. So what is a coronavirus? Well, technically, the virus is named the Severe Acute Respiratory Syndrome Coronavirus 2, or SARS-CoV-2. The disease it causes is called COVID-19. The number stands for 2019, the year it emerged. It's called a coronavirus for the crown-like spikes that they have on their surfaces. This type of virus typically infects bats, pigs, and small mammals. But they mutate easily and can jump from animal to humans and from one human to another. There are 7 strains of coronavirus known to infect humans, including this new virus. They typically cause illnesses in the respiratory tract, and 4 of those strains cause what we describe as common colds. 2 others rank among the more deadly of human infections. These would be SARS, the Severe Acute Respiratory Syndrome, and the Middle East Respiratory Syndrome, or MERS. Now, according to the CDC, our current understanding about this new coronavirus is largely based upon what is known about similar coronaviruses. The virus is thought to spread mainly from person to person, people who are in close contact with one another, about 6 feet, through respiratory droplets produced when an infected person coughs or sneezes. It is possible that a person can get COVID-19 by touching a surface or object that has the virus on it, and then touching their own face. But this is not the main way the virus is spread. People are thought to be most contagious when they are the most symptomatic, that is, the sickest. Some spread might be possible before people show symptoms. There have been reports of this occurring, but again, this is not thought to be the main way the virus spreads. There have also been some dire predictions for the spread of the new coronavirus. In particular, Dr. Nils Dallaire, if I pronounced that name wrong, I apologize, but he's the former Assistant Secretary at the Department of Health and Human Services, and he said it is now a near certainty that it will spread to all corners of the globe and affect every country. Well, whenever I hear comments like that, it brings to mind the advice of author Douglas Adams. Don't panic. While we don't know everything about this new virus, we do know some. Disease modeling experts have estimated that on average, each infected person has transmitted the virus to a range of 1.5 to 3.5 others. While those rates are higher than for some flu viruses, they are lower than for SARS, and they are far lower than for, say, the measles. It also appears to be less deadly than SARS, particularly the epidemic of 2003. The mortality rate for SARS at that time was about 10% of the people it infected, while only about 2.9% of the people confirmed to be infected with the new coronavirus have died. This is according to the World Health Organization. So if the virus appears to be less deadly than SARS and not as contagious as the measles, why the reaction, you might ask? Well, 3 basic reasons. First, a slow incubation has allowed the new virus to reach around the globe, infecting more people. As of February 28th, there were 84,184 confirmed cases and 2,876 deaths. Secondly, we really don't know enough about the virus, including how to combat it. This means we can't fully understand the economic impact that it will have before it's contained. Thirdly, there's a concern that the combination of those 2 previous points will push the global economy into recession. Now, that leaves a lot of room for people to fill in the gaps with their own imaginations, and perhaps with a little bit of help from Hollywood. Investor reactions, then, have been a result of questions and lack of information. As we know, the stock market hates uncertainty. So in times of low or no information, markets tend to overreact. To avoid getting swept along with the panic mongers, we need to look at the reported facts. At the epicenter of the virus, China is saying their figures show the number of their people who have recovered from the virus now exceeds the number of those who still have it. This is meant to show that they're winning the battle for containment. South Korea, with the highest coronavirus count outside of China, has granted broad authority to implement containment policies that restrict domestic travel and block public activities. They've also added more than $13 billion in emergency funds to stoke economic activity. Italy will inject $3.6 billion into its economy to mitigate the impact of the largest outbreak of coronavirus in Europe. Japan declared a state of emergency in a bid to contain its own outbreak. Even the U.S. government has said that it was operating on the assumption the virus would spread in the country and said we should prepare for social distancing measures, such as closing schools and canceling large-scale events. In a testament to how serious the world is taking containment of the virus, a senior member of the International Olympic Committee said cancellation of the upcoming games in Japan is a possibility. Perhaps then it would be best to make comparisons to the worst pandemic of roughly the past 100 years, the Spanish flu. In fact, in November of 2007, Thomas Garrett, the assistant vice president and economist at the Federal Reserve Bank of St. Louis, put together a report to do just that. The justification for the report was to estimate the economic impact of a worst-case scenario for a modern pandemic. In the report, predictions for a current pandemic are based upon the global influenza pandemic of 1918, which killed 675,000 people in the United States. Now that's nearly 0.8% of the 1910 population, and killed 40 million people worldwide from the early spring of 1918 through the late spring of 1919. At the height of the Spanish flu pandemic, the Boston Stock Exchange was shut, coal, steel, and textile production was hit, customers avoided shopping entirely, and in some cities, shops were forced to close by authorities. So to be comparable to the Spanish flu, The World Bank estimates that a global influenza pandemic would cost the world economy $800 billion and kill tens of millions of people. The U.S. Department of Health and Human Services estimates a Spanish flu-like pandemic would result in up to 1.9 million dead in the United States and initial economic costs of near $200 billion. Despite all of these severe impacts to the global and U.S. economies, Mr. Garrett still concludes that most of the evidence indicates the economic effects of the 1918 influenza pandemic were short-term. In fact, during that time, the Dow Jones average fell only 11% from its peak. Now, we're nowhere near Spanish flu numbers. At the current mortality rate, about 20% of the U.S. would need to be infected by the coronavirus to reach that level. So what does this mean for investors? Barring a significant mutation, even a pandemic will likely be over within a few months, and growth should resume. There will be some impact on the economy, some of which may linger as companies and consumers adapt, but much of the worst case appears to be factored in. Now, this doesn't mean that fear and uncertainty won't drive the market lower, or that this volatility is over, but we must bear in mind that as of now, the U.S. economy remains strong. Corrections, like the one we're in, may present buying opportunities, but focus on the fundamentals. Overreactions that are driven by technical data sometimes result in rapid recoveries. Don't get caught in whipsaw trades and avoid trying to time the market. The best defense against normal market volatility, even big swings like these, is a well-diversified portfolio that matches your risk tolerance. We will continue to evaluate this situation and look for opportunities as they arise. I'm Steve Memory with Iconic Wealth Management, and that's all for this February 2020 commentary. Remember, nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call at 703-891-9518. We'd be happy to talk with you.